Wherever you are right now, I hope you have found a comfortable place to rest. Perhaps you're lying down in a quiet room, or sitting in a chair as the day slowly winds to its close. Maybe the lights are dim, and the world outside your window has begun to settle into its evening rhythm. Whatever your circumstances, I invite you to take a slow breath, to let your shoulders drop, and to allow yourself to drift gently into thought. Tonight, we're going on a journey together, a long and winding exploration through one of the most fascinating intersections of human behavior, mathematics, and the subtle architecture of modern life. We're going to explore the economics of bubbles and crashes, and more specifically, what artificial stock markets, those strange computational mirrors of human desire and fear, have taught us about the real ones. What is a bubble, really? If you close your eyes and think about the word, you might picture something fragile and translucent, floating through the air, catching the light in rainbow patterns before it vanishes with the softest touch. And in many ways, that image captures something essential about financial bubbles. They are beautiful in their ascent, captivating in their shimmer, and heartbreaking in their sudden disappearance. But unlike soap bubbles drifting on a summer breeze, financial bubbles carry with them the weight of human hope, the accumulated dreams of thousands or millions of people who believed for a time that this time would be different, that the prices would keep rising forever, that wealth could be conjured from belief alone. Tonight we will take our time. There is no rush. We have hours ahead of us to wander through this territory, to examine it from every angle, to let the ideas settle into place like sediment drifting to the bottom of a still pond. We will begin with the most basic questions and gradually build our understanding layer by layer until we can see the whole picture. And at the heart of our exploration will be a remarkable discovery, one that emerged over the past few decades as computer scientists and economists began to build artificial worlds inside their machines. Worlds where digital traders bought and sold imaginary stocks according to simple rules, and where, to everyone's surprise, the same patterns of euphoria and panic that plague real markets emerge spontaneously from the code. But before we arrive at those artificial markets, we need to understand what they were trying to explain. We need to feel, in our bones, what a bubble is and why it matters. So let us begin at the beginning with one of the oldest and most famous bubbles in history, a moment when the rational world seemed to tilt on its axis, and an entire society became convinced that a flower bulb was worth more than a house. It was the winter of 1636 in the Netherlands, and something strange was happening in the taverns and coffee houses of Amsterdam, Haarlem and Leiden. Merchants and weavers, nobles and cobblers, people from every walk of life were gathering round tables covered with papers and ledgers, engaged in a peculiar form of commerce. They were trading tulip bulbs. Not the flowers themselves, mind you, but contracts for bulbs that would be delivered in the spring, bulbs that in some cases did not even exist yet, bulbs that were still sleeping in the frozen earth. And the prices being paid were extraordinary. A single bulb of the Semper Augustus variety, with its dramatic red and white flames, could fetch the equivalent of 10 years' wages for a skilled craftsman. People were selling their homes, their land, their livelihoods, all to acquire these promises of future flowers. To understand how this happened, we need to step back even further to understand what tulips meant in that time and place. The tulip was not native to Europe. It had arrived from the Ottoman Empire in the middle of the 16th century, brought by botanists who were fascinated by its elegant form and vivid colours. In an age when most flowers were variations of white, pink or yellow, the tulip offered something unprecedented: deep reds, rich purples, and most coveted of all, Those dramatic variegated patterns where colours seem to flame across the petals in unpredictable ways. What people did not know at the time was that these patterns were caused by a virus, a mosaic virus that infected the bulbs and created those striking variations. But not knowing the cause only added to the mystique. These flowers seemed touched by something divine, something beyond human control. In the Netherlands of the early 17th century, the tulip became more than just a flower. It became a symbol of wealth, of taste, of participation in the new merchant class that was transforming Dutch society. The Dutch Republic was experiencing an unprecedented economic boom. Trade ships returned from the East Indies laden with spices and silk. The financial innovations that would eventually give birth to modern capitalism were being invented in the counting houses of Amsterdam. Banks, stock companies, futures contracts, all of these instruments were new, and the society was drunk on possibility. Into this atmosphere of innovation and wealth came the tulip, rare and beautiful and perfectly suited to signal one's status. And so the prices began to rise. At first, this was simple supply and demand. Tulips take years to cultivate from seed, and the rare varieties could only be propagated slowly through offsets from the mother bulb. Demand outstripped supply, and prices increased accordingly. But then something else began to happen, something that would recur throughout financial history in countless forms. People began to buy tulips not because they wanted to plant them in their gardens, but because they expected the price to keep rising. They bought them to sell them to someone else at a higher price. The tulip stopped being primarily a flower and became primarily an asset, a vessel for speculation. The mechanics of the trade became increasingly sophisticated. Since actual bulbs could only be safely dug up and transplanted during certain months, a system of contracts developed. You could buy a promise of a bulb to be delivered in the future. This is what we would now call a futures contract, and these contracts themselves could be bought and sold, traded from hand to hand, their prices fluctuating wildly based on rumour and expectation. The trade moved from the formal settings of merchants' offices into taverns, where deals were sealed over drinks and recorded in ledgers kept by the tavern keepers. The barrier to entry dropped. Anyone could participate. The shoemaker, the carpenter, the baker, all could dream of making their fortune in tulips. There are stories from this period that sound almost mythical in their excess. A sailor, newly arrived in port and mistaking a valuable tulip bulb for an onion, ate it with his herring breakfast. The merchant who owned the bulb had him arrested. The value of what he had consumed could have fed the sailor for a year. Another tale tells of a bulb being traded for a complete estate, 12 acres of land included. Whether all these stories are literally true or have been embellished over time, they capture something real about the atmosphere of the moment, a society-wide intoxication with possibility, a collective suspension of disbelief. And then, as suddenly as it had inflated, the bubble burst. In February of 1637, at a bulb auction in Haarlem, something shifted. Perhaps there were fewer buyers than expected. Perhaps someone asked the obvious question out loud: why exactly should a flower bulb cost more than a house? Whatever the trigger, confidence evaporated, prices collapsed. Within weeks, bulbs that had been worth fortunes were worth a tiny fraction of their peak prices. Contracts were broken, lawsuits multiplied, many people were ruined. The government eventually stepped in to allow contracts to be resolved for a tiny percentage of their face value, but the damage was done. The dream had turned into a nightmare. The tulip mania has become the prototype, the original cautionary tale of speculative excess. When economists and journalists want to describe a bubble, they reach for the tulip as their metaphor. And yet, for all its fame, the tulip mania was actually relatively contained. It did not bring down banks or cause widespread systemic collapse. Life in the Netherlands went on. The truly devastating bubbles would come later, in different forms, in different centuries. But the pattern had been established. The human pattern of enthusiasm building upon itself, of prices rising because they had risen, of the moment when everyone suddenly realizes that the emperor has no clothes. Let us move forward in time now, centuries forward, past the South Sea bubble of 1720 and the Mississippi bubble of the same era, past countless smaller manias and panics to the late 20th century. By now, markets had become vastly more complex. Stock exchanges operated on an international scale. Information travelled at the speed of light through fibre optic cables. Sophisticated financial instruments had been invented, derivatives and options and securities backed by securities backed by other securities. And yet, for all this complexity, for all the advanced mathematics and computer systems, bubbles still formed and burst with startling regularity. In the 1990s, a new technology captured the world's imagination much as the tulip had captured the Netherlands 3.5 centuries earlier. The internet was transforming human communication, and anyone could see that something revolutionary was happening. The question was what it meant economically. How much value should be assigned to companies that existed primarily in cyberspace? Companies that had never turned a profit but promised to reshape entire industries. The answer, for a few years, seemed to be anything goes. Investors poured money into any company with a .com in its name. Stock prices soared to dizzying heights. A company could go public and see its value multiply tenfold in a day. Young entrepreneurs became paper billionaires overnight. It felt like the dawn of a new era, where the old rules of profitability and cash flow no longer applied. And then, starting in the spring of 2000, the bubble began to deflate. It started slowly at first, a few high-flying stocks declining, some investors taking profits. But the decline fed on itself. As prices fell, investors who had bought on borrowed money were forced to sell. As they sold, prices fell further. The panic spread. By the time it was over, trillions of dollars in market value had evaporated. Companies that had been worth billions shut their doors. The Nasdaq Composite Index, heavy with technology stocks, lost more than 75% of its value from peak to trough. Retirement accounts shrank, jobs disappeared. The exuberance turned to despair. The pattern was the same as it had been with tulips, just operating at a much larger scale and much greater speed. Belief building upon belief, prices rising because they had risen, the suspension of conventional valuation methods, the conviction that this time was different, that the old rules no longer applied, and then the sudden recognition that gravity had not in fact been repealed. The crash, the recriminations, the vows that it would never happen again. And yet it did happen again. It has happened again and again throughout human history, and it continues to happen today. Bubbles form in real estate markets, in commodity markets, in cryptocurrency markets, in markets for art and vintage cars and trading cards. The specific asset changes, but the underlying dynamics remain eerily consistent. Which brings us to the central puzzle that has occupied economists for generations. Why? Why do intelligent, rational human beings repeatedly fall into these traps? Why do markets, which are supposed to efficiently aggregate information and arrive at correct prices, instead sometimes careen wildly between euphoria and despair? And more practically, is there anything that can be done to prevent these destructive cycles, or at least to limit their damage? For a long time, mainstream economics struggled with these questions. The dominant theories of the 20th century were built on assumptions of rationality, on the idea that markets were fundamentally efficient, that prices reflected all available information, that bubbles, if they existed at all, were rare aberrations caused by external shocks or government interference. These theories were elegant and mathematically sophisticated, but they had a problem. They could not explain what was obviously happening in the real world. The bubbles kept occurring. The crashes kept coming. The gap between theory and reality became increasingly difficult to ignore. And so, starting in the 1980s and accelerating in the 1990s, a new approach began to emerge. Researchers started to question the assumption of perfect rationality. They began to study actual human psychology, the biases and heuristics and emotional responses that shape how real people make financial decisions. This field became known as behavioral economics and behavioral finance. At the same time, a parallel development was happening in computer science and complexity theory. Researchers were building artificial worlds inside computers, agent-based models where thousands of simulated entities interacted according to simple rules, and where complex emergent behavior arose from those interactions. And when these two streams of research came together, when economists and computer scientists began building artificial stock markets populated by agents with realistic psychological characteristics, something remarkable happened. The bubbles appeared spontaneously in the simulations. The crashes emerged naturally from the code. The artificial markets began to mirror the real ones in uncanny ways. This is where our journey really begins. In the following hours, we will explore these artificial stock markets in detail. We will understand how they work, what they revealed about market dynamics, and what lessons they hold for understanding and perhaps managing real financial markets. But to appreciate their significance, we need to understand the intellectual revolution they represented, the move away from elegant but unrealistic theories toward messier but more accurate models that embrace the complexity and irrationality of human behavior. Imagine for a moment that you could build a world from scratch. Not a physical world, but an economic world. A market where traders buy and sell according to whatever rules you choose to program. You could make the traders perfectly rational if you wanted, giving them unlimited computational power and complete information. You could run the simulation forward in time, watching prices evolve, seeing how the market reaches equilibrium. This is essentially what traditional economic models try to do mathematically, to derive from first principles how a perfectly rational market would behave. But what if you tried something different? What if you made your simulated traders more like real human beings? What if you gave them limited information, imperfect memories, and the tendency to learn from experience in simple, rule-based ways? What if you allowed them to look at what other traders were doing and to imitate successful strategies? What if you introduced a bit of randomness to reflect the fact that real decisions are influenced by mood, by context, by factors that have nothing to do with optimal calculation? And then what if you turned on the simulation and watched what happened? This is exactly what a group of researchers at the Santa Fe Institute in New Mexico began doing in the early 1990s. The Santa Fe Institute had been founded a few years earlier as an unusual kind of research center, a place where physicists and biologists and economists and computer scientists could work together on problems of complexity, on understanding how simple rules could give rise to intricate patterns, how order could emerge from chaos. The artificial stock market project began as a collaboration between economists who were dissatisfied with traditional models and computer scientists who were excited about agent-based modeling as a tool for understanding complex systems. The basic setup was this. The artificial market contained a single stock, representing a simplified version of a real equity that pays dividends. There was also a risk-free bond, representing the alternative of just holding cash. The market was populated by a number of artificial traders, computer programs that we will call agents. Each agent had the same basic goal: to maximize its wealth over time by deciding in each period how much of its money to allocate to the stock and how much to keep in the risk-free asset. But the agents were not given perfect information about the future. They had to form forecasts, predictions about what the dividend would be and what the price would be in the next period. And here is where it gets interesting. The agents were given a collection of different forecasting rules, different ways of predicting future prices based on past information. These rules range from simple, the price tomorrow will be the same as the price today, to more complex, the price will depend on moving averages, on trading volume, on how far the current price is from some historical mean. The agents did not know in advance which forecasting rules would work best. They had to learn through experience. Each agent maintained a portfolio of prediction rules and kept track of which ones had been most accurate in the recent past. The rules that made good predictions got used more often. The rules that made poor predictions were gradually discarded. This is a form of learning known as reinforcement learning or evolutionary learning, and it is much more realistic than assuming that agents somehow know the correct model of the world from the beginning. Real traders learn by trial and error. They try strategies, see what works, and adjust accordingly. The artificial agents were doing the same thing. Now, here is what the researchers expected to happen. They thought that over time the agents would converge on good forecasting rules. The market would settle into a rational expectations equilibrium, the kind predicted by traditional theory. The price would accurately reflect the fundamental value of the stock, which in this simple world is determined by the expected future dividends. There might be some initial volatility as the agents learned, but eventually things would calm down and the market would behave efficiently. But that is not what happened. When the simulation was run, the market did not settle into a stable equilibrium. Instead, it exhibited rich and complex dynamics. Prices would trade near fundamental value for a while, and then they would start to drift upward or downward. Bubbles would form, periods where the price rose well above what the dividends could justify. These bubbles would persist for a while, sometimes for long stretches of simulated time, and then they would burst, often quite suddenly. The price would crash, overshooting on the downside, trading below fundamental value for a period before eventually recovering. Trading volume would surge during volatile periods and subside during calm ones. The statistical properties of the simulated price series, the volatility clustering, the fat tails in the return distribution, looked remarkably like those of real stock market data. The researchers were stunned. They had not programmed bubbles and crashes into the model. Those phenomena had emerged spontaneously from the interactions of learning agents. They tried tweaking the parameters, changing the number of agents, adjusting the learning algorithms, modifying the prediction rules available to the agents. And while the details changed, the basic phenomena persisted. The artificial market was generating bubbles and crashes as a natural consequence of how boundedly rational agents learn and interact in a market setting. This was a profound discovery. It suggested that you do not need irrational exuberance or herd behavior or manipulation or outside shocks to generate bubbles. You do not need to invoke tulip fever or the madness of crowds. Bubbles can emerge naturally in a market populated by agents who are trying their best to make good forecasts and maximize their returns, but who have limited information and must learn through experience. The very process of learning of adapting strategies based on recent success can create feedback loops that push prices away from fundamental values. And these feedback loops can be self-reinforcing for a time, creating the illusion that the new price level is justified until some small shift causes the structure to collapse. Let us pause for a moment and consider what this means. The Santa Fe artificial stock market was showing us something fundamental about how markets work. Traditional economic theory had assumed that if you put rational agents in a market, they would quickly figure out the right prices. Any deviation from fundamental value would be immediately arbitraged away by smart traders. But the artificial market was demonstrating that this assumption breaks down when agents must learn through experience rather than knowing the correct model from the start. The very act of learning creates dynamics that can push the market away from equilibrium. Think about it this way. Imagine you are one of these artificial agents trying to decide whether to buy or sell the stock. You have a collection of forecasting rules, some simple, some more complex. You look at which rules have been accurate recently, and you use those to make your prediction about tomorrow's price. Now, if the price has been rising steadily, the rules that predict continuation of the trend will have been accurate, so you will rely more heavily on those trend-following rules. And if you rely on them, you will buy more of the stock expecting the price to keep rising. But you're not the only agent doing this. Many other agents are also noticing that trend-following rules have been working well. They too shift toward using those rules, and as they all buy based on the expectation of further price increases, they create the very price increases they were predicting. The prophecy becomes self-fulfilling. This is a positive feedback loop. The price rises, which makes trend-following rules look accurate, which causes agents to buy more, which pushes the price higher, which makes trend-following rules look even better, and so on. For a time, this can continue. The bubble inflates. Agents who use the trend-following rules make money. Their success reinforces the behavior. New agents or existing agents with different strategies see this success and adapt their own forecast to incorporate trend following. The bubble grows larger. But there is a problem. The price is now far above what the fundamentals justify. The stock is paying a certain dividend, and at some point the price becomes so high relative to that dividend that the expected return is very low or even negative. Eventually, some agents begin to notice this. Perhaps their fundamental value rules start suggesting that the stock is overpriced. Or perhaps just by chance, some agents decide to sell, to take their profits. When enough agents start selling, the price stops rising. And when the price stops rising, the trend-following rules that had been so successful suddenly start making bad predictions. The agents who relied on them lose money. They shift away from trend following and toward other strategies. More selling ensues. The feedback loop reverses. Now falling prices make mean reversion rules look accurate. The rules that predict the price will fall back toward fundamental value. Agents pile into these strategies selling the stock. The crash accelerates. The price overshoots on the downside, falling below fundamental value, and eventually the process stabilizes, only to potentially repeat again later. This mechanism, this interplay between learning and market dynamics, is at the heart of why the artificial stock market generated bubbles. And what is remarkable is how robust this finding was. The researchers tried many variations. They changed the learning algorithms. They tried genetic algorithms where strategies evolved over time, with successful strategies reproducing and unsuccessful ones dying out. They tried reinforcement learning where agents updated their strategies based on the rewards they received. They varied the number of agents, the diversity of forecasting rules, the speed of learning. And while the specific patterns changed, the fundamental result remained. Markets with learning agents exhibited complex dynamics, including bubbles and crashes, even in the absence of any external shocks or irrational behavior. Now, you might wonder whether this was just an artifact of the particular model the Santa Fe researchers built. Perhaps if you changed the assumptions, the bubbles would go away. This is a fair question, and it has been explored extensively. Over the years since that initial work, hundreds of artificial stock market models have been built by researchers around the world. They have varied the details in countless ways. Some models include multiple stocks. Some include different types of agents, fundamentalists who try to estimate true value, and chartists who follow price trends. Some models include leverage, allowing agents to borrow money to amplify their bets. Some include more realistic market microstructure, with bid-ask spreads and order books. And yet, across this vast landscape of models, certain findings recur. Markets with heterogeneous learning agents tend to exhibit volatility that exceeds what fundamental news would justify. They tend to produce fat-tailed return distributions, meaning extreme events are more common than a normal distribution would predict, and they tend to generate bubbles and crashes. One particularly elegant demonstration of this comes from models that include two types of agents: fundamentalists and chartists, sometimes called noise traders. The fundamentalists try to estimate the intrinsic value of the asset and buy when the price is below that value, sell when it is above. The chartists ignore fundamentals and simply follow price trends, buying when prices are rising and selling when they are falling. You might think that the fundamentalists would dominate the market, that their superior information about true value would allow them to profit at the expense of the chartists, and that eventually the chartists would be driven out. But this is not what happens in these models. Instead, the two types of traders coexist, and their interaction creates complex dynamics. Here is why. When the market is calm and prices are near fundamental value, the fundamentalists do well. Their strategy of buying low and selling high generates steady profits. The chartists do not do particularly well because there are no strong trends to follow, but then perhaps by chance the price starts to move away from fundamental value. Maybe there is a small positive shock to the dividend, or maybe just random fluctuations push the price up a bit. The chartists notice the upward trend and start buying. Their buying pushes the price higher, creating more of a trend. Now the chartists are making money because they bought early in the trend. The fundamentalists, meanwhile, see that the price is moving away from fundamental value and they start selling. But they are outnumbered or outweighed by the chartist buying, so the price continues to rise. The fundamentalists lose money in the short term because they sold too early. The success of the chartist attracts more agents to that strategy. The bubble grows. Eventually, the price becomes so disconnected from fundamentals that even the chartist buying cannot sustain it. The trend weakens. Some chartists start to sell. The fundamentalists who have been waiting patiently increase their selling. The bubble bursts. On the way down, the chartists now follow the downward trend, accelerating the crash. The fundamentalists buy on the way down, but again they are initially overwhelmed. The price overshoots below fundamental value. Eventually it stabilizes, the fundamentalists profit from their patience, and the cycle can begin again. This model captures something important about real markets. It shows that you do not need all investors to be irrational for bubbles to occur. You just need a mix of strategies, some based on fundamentals and some based on trends or momentum. The interaction between these strategies, mediated through the price mechanism, can generate excess volatility and bubbles even though each individual agent is acting rationally given their information and objectives. The irrationality, if we want to call it that, is a property of the system, not of the individual agents. There is a deeper philosophical point here, one worth dwelling on as we settle further into our journey tonight. For centuries, economics has been wrestling with the question of rationality. Are people rational? Do markets behave as if people are rational? Traditional economics said yes, and built elaborate theories on that foundation. Behavioral economics came along and said no, look at all these ways people are biased and make mistakes. But the artificial stock markets suggest a third perspective. Maybe the question itself is not quite right. Maybe what matters is not whether individuals are rational in some absolute sense, but how learning agents interact in complex systems. An agent following a trend is not being irrational, it is using a heuristic that works well under certain conditions. The problem is that when many agents use similar heuristics, their collective behavior can create conditions where those heuristics lead the system astray. This is a theme we will return to again and again. Markets are not just collections of isolated individuals making independent decisions. They are systems where information flows, where behaviors influence other behaviors, where feedback loops can amplify small disturbances into large swings. To understand bubbles and crashes, we need to understand these system-level dynamics, not just individual psychology. But let us not get too abstract. Let us return to the concrete findings from the artificial markets and explore what they tell us about specific aspects of bubbles. One of the most striking findings concerns the role of leverage. Leverage means borrowing money to invest, amplifying both gains and losses. In many of the artificial market models, allowing agents to use leverage dramatically increases the size and frequency of bubbles. Why? Because leverage allows agents who believe in the trend to bet more heavily on it. When the trend is working, leveraged investors make even more money, which makes their strategy look even more attractive, which draws in more capital, including more borrowed capital. The bubble inflates faster and grows larger. But when it bursts, the losses are amplified as well. Leveraged investors are forced to sell to meet margin calls, which accelerates the crash. The positive feedback on the way up becomes a negative feedback loop on the way down. This insight from artificial markets has direct parallels to real financial crises. The dot-com bubble of the late 1990s was amplified by the ease with which investors could buy stocks on margin. The housing bubble of the mid-2000s was turbocharged by the availability of highly leveraged mortgages and complex derivatives that allowed investors to make large bets on housing with relatively little capital. When those bubbles burst, the deleveraging process, the unwinding of all that borrowed money, turned crashes into catastrophes. Banks failed. Credit markets froze. The global economy plunged into the deepest recession since the Great Depression. The artificial markets were showing us in miniature what would play out on a global scale. Another finding from artificial markets concerns the role of herding and social learning. Some models allow agents to observe what other agents are doing and to imitate successful strategies. This is a realistic feature. Real investors do watch what others are doing. They read market commentary. They notice which hedge funds are performing well and try to copy their approaches. They see their neighbors making money in real estate and decide to get in on the action. This social learning can be beneficial. It allows good strategies to spread quickly, but it can also amplify bubbles. When a particular strategy starts working, more and more agents adopt it. The strategy becomes crowded. Everyone is doing the same thing. And when the strategy stops working, everyone tries to exit at once. The crash is more severe than it would be if agents were making independent decisions. The artificial markets also shed light on the role of information and transparency. Some models explore what happens when agents have different levels of information. Perhaps some agents can see the true fundamental value while others cannot. Or perhaps some agents get information faster than others. What these models tend to show is that information asymmetry can exacerbate bubbles. The uninformed agents, not knowing the true value, rely more heavily on price trends as signals. They assume that if the price is rising, there must be good information driving it. They pile in, pushing the price even higher. The informed agents, meanwhile, see that the price is becoming disconnected from fundamentals, but they face a dilemma. If they try to short the market to bet against the bubble, they can lose money for a long time while the bubble continues to inflate. As the economist John Maynard Keynes famously observed, markets can remain irrational longer than you can remain solvent. This is sometimes called the synchronization problem. Informed traders know that the price is too high, but they do not know when it will correct. If they bet against it too early, they lose money and may be forced out of their positions before they are proven right. So even informed traders may ride the bubble for a while, hoping to get out before it bursts. This behavior, rational from an individual perspective, helps to sustain the bubble and makes the eventual crash more severe. The artificial markets capture this dynamic beautifully. You can watch individual agents who have good forecasting rules making the wrong trades, buying into an overpriced market, not because they are foolish, but because they are trying to time the market and profit from the trend before it reverses. Let us drift now into a slightly different territory, but one that connects deeply to our theme. We've been talking about artificial markets as tools for understanding the real economy. But there is another dimension to this story, one that involves the intersection of computer science and finance in a more direct way. Over the past few decades, financial markets have become increasingly computerized. Today, a large fraction of trading volume in major stock markets is generated by algorithms, computer programs that execute trades automatically based on predefined rules or learned strategies. These algorithms can trade far faster than any human, making decisions in microseconds, responding to price movements and news releases before a human could even perceive them. This development has been controversial. Proponents argue that algorithmic trading increases market efficiency, narrowing spreads and providing liquidity. Critics worry that it increases volatility and creates new risks, and there is evidence for both perspectives. On the one hand, spreads, the difference between the price you can buy at and the price you can sell at, have indeed narrowed over the years as algorithmic trading has grown. This is good for ordinary investors who pay less in implicit transaction costs. On the other hand, there have been episodes of extreme volatility that seem to be linked to algorithmic trading. The flash crash of May 6, 2010, is the most famous example. On that day, the US stock market plunged by about 9% in a matter of minutes, with some individual stocks temporarily losing almost all their value. The crash reversed almost as quickly as it had begun, but it left many observers shaken. What had happened? Investigations revealed a complex cascade of events involving algorithmic traders. A large sell order by a mutual fund was executed by an algorithm that sold very aggressively. High-frequency trading algorithms designed to provide liquidity initially absorbed the selling but then began to offload their positions to other algorithms. The algorithms were trading with each other in a circular pattern, with each one trying to pass the hot potato to the next. Prices spiraled downward as the algorithms reacted to each other's trades. Some algorithms had circuit breakers that caused them to stop trading when volatility became too extreme, which reduced liquidity further and accelerated the decline. It was only after certain automatic trading halts kicked in, giving the market time to reset, that stability was restored. The flash crash was not exactly a bubble, but it illustrated some of the same dynamics we've been discussing. Feedback loops, amplification of small disturbances, interactions between agents, in this case algorithmic agents, that create system-level instability. And it raised a troubling question. If we are increasingly turning over market operations to algorithms, and if those algorithms can interact in ways that create crashes, are we building a more fragile financial system? This is where the lessons from artificial stock markets become particularly relevant. The artificial markets of the 1990s were academic exercises, simulations run on research computers to understand market dynamics. But today's algorithmic trading systems are artificial markets in a much more literal sense. They're collections of autonomous agents, computer programs, interacting with each other and with human traders in real markets. And the concerns that the academic models highlighted about feedback loops, about herding, about the instability that can arise from agents learning and adapting are now playing out in real time in actual financial markets. Some researchers have proposed using the insights from agent-based models to design better trading algorithms and better market regulations. For example, if we know that herding behavior can amplify volatility, we might design algorithms to be more contrarian, to buy when others are selling and sell when others are buying, rather than following the crowd. Or we might implement circuit breakers that halt trading more aggressively when certain patterns emerge. Or we might require more transparency about algorithmic strategies so that regulators can identify potentially dangerous interactions before they cause a crash. But these are not easy problems to solve. The market is a complex adaptive system. When you change one part of it, other parts adapt in response. If you introduce a circuit breaker, traders will adjust their strategies to anticipate when it will be triggered. If you try to reduce herding, you might eliminate behaviors that are actually stabilizing in most circumstances. The law of unintended consequences looms large, and yet doing nothing is not an option either. As markets become more automated and faster moving, the potential for extreme events grows. We need to understand these systems better if we hope to manage their risks. This brings us back to the fundamental value of the artificial stock market research. These models are not perfect representations of reality. They leave out many important features of actual markets, but they are laboratories where we can experiment, where we can test ideas about how markets work and what interventions might help or hurt. We can run the same simulation 1,000 times with different random seeds and see how often bubbles occur, how large they get, how quickly they collapse. We can introduce a new regulation in the model and observe its effect without risking real money or real economic harm. We can build intuition about complex dynamics that would be impossible to understand through pure mathematical analysis or simple observation of real markets. In the years since the Santa Fe artificial stock market was first developed, the field has matured considerably. Models have become more sophisticated, incorporating richer representations of agent behavior, more realistic market microstructure, connections to macroeconomic variables. Researchers have calibrated models to match specific historical episodes, using them to understand what drove particular bubbles or crashes. And increasingly, these models are being used not just for academic research but for practical applications in risk management, in policy analysis, in the design of trading systems. One particularly interesting line of research involves using agent-based models to conduct stress tests of financial systems. Regulators want to know whether the banking system could withstand a major shock, a sharp drop in asset prices, a spike in default rates, a freeze in credit markets. Traditional stress tests use historical data and statistical models to simulate these scenarios. But agent-based models offer a complementary approach. They can simulate how different types of market participants, banks, hedge funds, pension funds, retail investors might react to a shock, and how those reactions might amplify the shock through feedback effects. This can reveal vulnerabilities that simpler models might miss. Let us take a breath here and reflect on the journey we've been on so far. We started with tulips, with a story from 4 centuries ago about people in the Netherlands paying exorbitant prices for flower bulbs. We moved through the dot-com bubble of the late 1990s. We explored the Santa Fe artificial stock market and what it revealed about learning agents and feedback loops. We considered how these insights apply to modern algorithmic trading. Throughout all of this, we've been circling around a central question. Why do markets sometimes go mad? Why do prices sometimes soar far above any reasonable valuation, only to crash back down? And what can we do about it? The artificial markets have given us part of the answer. Bubbles are not aberrations that require special explanation. They are natural consequences of how learning agents interact in markets. When people must form expectations about the future based on limited information and past experience, when their actions influence the very prices they are trying to predict, feedback loops emerge. These feedback loops can be stabilizing or destabilizing. Sometimes they push the market toward equilibrium, sometimes they push it away. And the difference between stability and instability can depend on subtle details, on the mix of strategies being used, on the speed of learning, on the availability of leverage, on the degree of herding. But understanding the mechanisms is only the first step. The harder question is what to do with that understanding. Can we design markets that are less prone to bubbles? Can we regulate them in ways that reduce the damage when bubbles do occur? Or are bubbles simply an unavoidable cost of having markets at all, a price we pay for the benefits they provide in allocating capital and aggregating information? These questions do not have easy answers, but before we try to address them, we need to go deeper into the psychology and sociology of bubbles. The artificial markets have shown us that bubbles can emerge from simple learning rules and feedback effects. But real bubbles involve more than that. They involve emotion, fear and greed, and hope and despair. They involve social dynamics, the stories we tell ourselves and each other about why this time is different. They involve cultural factors, the ways different societies think about risk and speculation and wealth. So in the next part of our journey, we will turn from the computational models to the human reality, to the actual experience of being caught in a bubble, to the patterns of thought and feeling that drive people to make decisions they later regret. But we are not done with the artificial markets yet. There is still more to learn from them, more patterns to observe, more insights to extract. We will return to them later, armed with a richer understanding of the human side of bubbles, and see what else they can teach us about this endlessly fascinating and sometimes terrifying phenomenon. For now, let us simply sit with what we have learned. Markets are complex systems. Learning creates feedback. Feedback can amplify. Amplification can lead to bubbles. Bubbles eventually burst. The pattern repeats. And understanding the pattern, really understanding it in all its details and implications, is the work we're undertaking together tonight. There is something deeply human about wanting to believe that this time is different. We tell ourselves that the old rules no longer apply, that we've entered a new era, that the patterns of the past are no longer relevant. This is not stupidity. It is not even quite irrational. After all, sometimes things really do change. Technologies emerge that transform entire industries. New business models create unprecedented opportunities. Regulatory frameworks shift. The world evolves, and what was true yesterday may not be true tomorrow. The difficulty lies in distinguishing genuine paradigm shifts from collective delusions. And in the heat of a bubble, when prices are rising and everyone around you seems to be getting rich, that distinction becomes nearly impossible to make. Let us consider for a moment what it feels like to be inside a bubble. Imagine it is 1999. The internet is transforming everything. Companies that barely existed a few years ago are now household names. Amazon is revolutionizing retail. Google is organizing the world's information. Ordinary people are starting businesses in their garages that attract millions in venture capital funding. Your neighbors, your co-workers, your relatives are all talking about their stock portfolios, about the killing they made on this IPO or that tech stock. You hear stories of 20-somethings retiring as millionaires, and you, cautious, prudent you, have been sitting on the sidelines, watching your safe, boring index funds grow at their modest historical rates, while everyone else seems to be minting money. The temptation is enormous. You start to feel foolish for not participating. You wonder whether you are missing the opportunity of a lifetime. After all, the internet really is revolutionary. The companies really are growing at unprecedented rates. Maybe the traditional valuation metrics, price-to-earnings ratios, dividend yields, all those old-fashioned measures really are obsolete. Maybe in the new economy, what matters is market share, brand recognition, network effects. Maybe profitability is overrated in the short term because once these companies achieve dominance, the profits will flow naturally. Everyone around you seems to believe this. Smart people, successful people, people with more money and more experience than you. Surely they cannot all be wrong, and so you dip your toe in. You buy a few shares of a hot tech stock, and it goes up. In a week, you have made more money than your savings account paid in a year. You feel exhilarated. You also feel a bit foolish for not doing this sooner, so you buy more, and that goes up too. Now you are checking stock prices multiple times a day. You are reading bulletin boards and chat rooms where investors share tips and predictions. You're learning a new language, a vocabulary of tickers and options and momentum plays. You are, without quite realizing it, being drawn into a world where the normal rules of prudence no longer seem to apply. This is the psychological reality of bubbles. It is not that people suddenly become stupid or reckless. It is that the environment changes in ways that make previously cautious behavior seem overly conservative. The social proof is overwhelming. Everyone is doing it. The recent evidence is compelling. It has been working. The logical arguments, when you hear them, sound plausible. And the fear of missing out, that gnawing anxiety that you're being left behind while others prosper, is a powerful motivator. Behavioral economists have documented this phenomenon extensively. They call it herding behavior, or social learning, or information cascades. By whatever name, it is a fundamental feature of human psychology. We are social creatures. We look to others for cues about how to behave, especially in uncertain situations. And markets are nothing if not uncertain. Now layer on top of this another psychological factor, confirmation bias. Once you've committed to a position, once you have bought into the narrative of the bubble, you become motivated to seek out information that confirms your decision and to discount information that challenges it. When you read a bullish analyst report on your stock, you nod in agreement. When you read a bearish one, you find reasons to dismiss it. The analyst does not understand the company. He is old school, stuck in outdated thinking. he has missed the point about network effects. Your mind, quite unconsciously, is working to protect your ego and your portfolio. And this is true not just for individual investors, but for professional money managers, for analysts, for journalists, for everyone caught up in the bubble. There is also a temporal dimension to bubbles that makes them particularly insidious. They do not happen overnight. They build gradually, over months or years. And during that time, the behavior that later looks crazy, like paying 50 times revenues for an unprofitable company, is being progressively normalized. Each step along the way seems like a small and reasonable extension of the previous step. Prices were at X, now they're at 1.1x. Is that really so different? And then at 1.2x, and then 1.5x, and so on, until you wake up one day and prices are at 3x and you cannot quite remember how you got there. But it no longer seems shocking because you've been living with the rising prices for so long. Psychologists call this shifting baseline syndrome or normalization of deviance. What once would have seemed abnormal gradually comes to feel normal through repeated exposure, and bubbles are perfect examples of this phenomenon. The longer the bubble lasts, the more entrenched the new normal becomes, the harder it is for people to recognize that anything is amiss. This is true even for sophisticated observers. Economists, market analysts, regulators, people whose job it is to monitor markets and identify risks, can get caught up in the same psychological currents as everyone else. During the housing bubble of the mid-2000s, how many experts assured us that nationwide housing prices had never fallen in the post-war era, so surely they would not fall now? How many sophisticated models failed to account for the possibility of a major correction because the recent data, the data from the bubble years, suggested that such a correction was vanishingly unlikely? The artificial stock markets we discussed earlier capture some of these dynamics through their learning mechanisms. Agents in those models update their strategies based on recent success. If a strategy has worked well in the recent past, it gets used more. This is a simple form of reinforcement learning, and it is roughly how humans actually behave. We try things, see what works, and do more of what works. The problem is that what works during a bubble, trend following, momentum chasing, is precisely the behavior that inflates the bubble further. So the learning process, entirely rational at the individual level, contributes to collective irrationality at the market level. But there is more to human psychology than simple reinforcement learning. There are emotions. Fear and greed, the twin poles of market sentiment, have been recognized since ancient times as driving forces in speculation. When prices are rising, greed takes over. Investors become focused on the potential gains they might miss if they do not participate. They discount risks. They leverage up, borrowing money to amplify their bets. They chase performance, moving money into whatever has been going up most recently. Greed is not just about wanting more money. It is about wanting to feel smart, successful, ahead of the crowd. It is about status and identity as much as about wealth. And then, when the bubble bursts, fear takes over. But it is not just fear of financial loss. It is existential fear. Fear of being a fool. Fear of having made catastrophic mistakes. Fear of having to admit to yourself and to others that you were wrong. This fear drives panic selling. Investors dump assets at any price, desperate to get out before things get worse. They stop thinking about fundamentals or long-term value. All that matters is escape. And because everyone is trying to escape at once, the selling overwhelms any buying interest. Prices collapse. The fear feeds on itself, just as the greed did on the way up. The emotional roller coaster of bubbles and crashes is something that the artificial markets, for all their sophistication, do not fully capture. Computer agents do not feel fear or greed. They follow their programming. And yet, the dynamics that emerge from simple learning rules mirror the emotional dynamics of real markets. The mathematical structure of positive and negative feedback loops can produce patterns that look remarkably like the psychological patterns of euphoria and panic. This suggests something profound. Perhaps the emotions are not separate from the market dynamics. Perhaps they are part of the same system. The feedback loops work through human psychology. Prices rise, which makes people greedy, which makes them buy, which pushes prices higher. Then prices fall, which makes people afraid, which makes them sell, which pushes prices lower. The emotions are the medium through which the feedback operates. Let us explore a specific historical example in more depth to see how these psychological factors played out. The housing bubble of the mid-2000s is a particularly instructive case because it was so recent and so well documented, and because its collapse had such devastating consequences. By the early 2000s, interest rates were low, having been cut by the Federal Reserve to stimulate the economy after the dot-com crash and the 9/11 terrorist attacks. Mortgage lending had been deregulated, and new financial instruments made it easier for people to borrow money to buy homes. Subprime mortgages, loans to borrowers with poor credit, became widely available. Adjustable rate mortgages, with low initial payments that would later reset to much higher rates, were aggressively marketed. And crucially, a narrative took hold that home prices only go up. This narrative had some basis in reality. For decades, housing prices in the United States had indeed risen steadily, with only brief and localized dips. Homes were not just places to live. They were investments, stores of wealth, retirement nest eggs. And unlike stocks, they were tangible. You could see them, touch them, live in them. They felt safe. This perception of safety, combined with easy credit, unleashed a wave of buying. People who could not previously afford homes were suddenly able to get mortgages. People who already owned homes bought second homes or investment properties. Speculators entered the market, buying properties with the sole intention of flipping them for a quick profit. Demand surged and prices rose. And as prices rose, the narrative became self-reinforcing. Look, home prices are up 20% this year. Buying a home is the smartest investment you can make. You cannot lose. Lenders, seeing the rising prices, became more willing to lend. After all, if the borrower defaulted, the lender could foreclose and sell the property for more than the loan amount. The rising prices seem to reduce risk. Of course, this logic only works if prices keep rising. But during the bubble, that seemed like a safe assumption, and the lenders were not keeping the loans on their own books anyway. They were selling them to investment banks, which packaged them into securities and sold them to investors around the world. This process, called securitization, was supposed to spread risk and make the financial system more stable. But it had an unintended consequence. It severed the link between lending decisions and the risk of default. The person making the loan did not bear the risk if the borrower could not pay. This created a moral hazard. Lenders had an incentive to make as many loans as possible, regardless of quality, because they could pass the risk along to someone else, and so lending standards deteriorated. People were approved for loans they had no realistic ability to repay. Stated income loans, where borrowers simply declared how much they earned without any verification, became common. These were nicknamed liar loans. Option adjustable rate mortgages allowed borrowers to make payments so small that they did not even cover the interest, causing the loan balance to grow over time. None of this made sense from a traditional lending perspective, but in the bubble environment, with prices rising and everyone making money, it seemed to work. The default rates remained low, not because the borrowers were creditworthy, but because rising prices allowed struggling borrowers to refinance or sell their homes for a profit before defaulting. On Wall Street, the mortgage-backed securities were being sliced and diced into ever more complex instruments. Collateralized debt obligations, CDOs, took pools of mortgages and divided them into tranches with different levels of risk and return. The senior tranches, first in line to receive payments, were rated AA, the same rating as US Treasury bonds, despite being backed by subprime mortgages. The rating agencies paid by the investment banks that created these securities gave them rosy ratings. Whether this was due to incompetence, conflicts of interest, or genuine belief in the models that said these securities were safe is still debated. But the result was that investors who thought they were buying safe assets were actually exposed to enormous risk. And then there were the synthetic CDOs, instruments that did not even contain actual mortgages, but were bets on the performance of other mortgage-backed securities. These allowed investors to make leveraged wagers on the housing market, amplifying both the potential gains and the potential losses. The financial system was becoming a house of cards, with layer upon layer of leverage and complexity built on top of the underlying mortgages, and very few people understood the full picture. Each participant, the home buyer, the mortgage broker, the lender, the securitizer, the rating agency, the investor, saw only their small piece of the puzzle. The systemic risk, the danger that a decline in home prices could set off a cascade of failures throughout the financial system, was largely invisible. There were warnings. A few economists, a few analysts, a few journalists pointed out that home prices had risen far above historical norms relative to incomes or rents. They noted that the lending practices were unsustainable. They warned that the complex securities were mispriced and dangerous. But these warnings were largely ignored or dismissed. The bubble mentality was too entrenched. Prices were still rising. Money was still being made. The skeptics were seen as Cassandras, perennial pessimists who did not understand the new paradigm. And then, in late 2006, home prices stopped rising. They flattened, and then they began to fall. At first, the declines were modest and localized, but they set off a chain reaction. Homeowners who had stretched to buy properties with adjustable rate mortgages found themselves unable to afford the higher payments when the rates reset. They could not refinance because prices had fallen and they no longer had enough equity. They could not sell because there were no buyers at the inflated prices. Defaults began to rise. The securities backed by these mortgages began to lose value. Investors who had bought them, thinking they were safe, suddenly faced huge losses. The rating agencies downgraded the securities, which forced some investors to sell, which pushed prices down further. By 2007, the crisis was spreading beyond housing. Financial institutions that had large exposures to mortgage-backed securities were in trouble. Bear Stearns, a major investment bank, saw two of its hedge funds collapse. In 2008, the crisis intensified. Bear Stearns itself failed and was acquired by JP Morgan Chase in a government-brokered deal. Lehman Brothers, another major investment bank, filed for bankruptcy in September 2008, the largest bankruptcy in US history at that time. AIG, a giant insurance company that had sold credit default swaps insuring mortgage-backed securities, nearly collapsed and was bailed out by the government. The financial system was on the brink of total meltdown. The panic was extraordinary. Credit markets froze. Banks stopped lending to each other because they did not know which institutions were solvent and which were on the verge of failure. The commercial paper market, where companies borrow money for short-term needs like payroll, seized up. Money market funds, long considered as safe as cash, faced runs as investors tried to withdraw their money. The stock market plunged, with the S&P 500 falling more than 50% from its peak. Unemployment surged as businesses cut back or shut down. The global economy entered the deepest recession since the 1930s. The human cost was staggering. Millions of people lost their homes to foreclosure. Retirement savings evaporated. Jobs disappeared. Communities were devastated as neighborhoods filled with empty, foreclosed properties. The crisis wiped out trillions of dollars of wealth and left scars that persisted for years. And it all traced back to the bubble, to the collective delusion that home prices could only go up, to the layers of leverage and complexity that amplified the problem, to the failure of individuals and institutions to recognize the risks until it was too late. Now, how do the artificial stock markets help us understand what happened? In several ways. First, they show us that even without fraud or irrationality, bubbles can emerge from the interaction of learning agents in markets with leverage and complex securities. The housing bubble certainly involved elements of fraud, predatory lending, and regulatory failure. But underneath those problems was the same basic dynamic that the artificial markets reveal. People learned that buying homes and mortgages was profitable. That learning reinforced the behavior. Prices rose, which made the behavior seem even more profitable, which drew in more participants. Leverage amplified the whole process. And then, when the trend reversed, the feedback loop went into reverse with devastating effect. Second, the artificial markets illustrate the importance of system-level analysis. You cannot understand the housing bubble by looking at any single participant. The home buyer who stretched to buy a house, the lender who made the risky loan, the investment bank that securitized it, the rating agency that blessed it, the investor who bought it. Each made decisions that seemed reasonable from their individual perspective, given the information and incentives they faced. But the system as a whole was fragile and unstable. The artificial markets show us that this is not unusual. Complex adaptive systems can exhibit properties that are not present in any of their individual components. Stability or instability, resilience or fragility, these are emergent properties that arise from the interactions. Third, the artificial markets offer a way to think about policy responses. After the crisis, there was much debate about what should be done to prevent a recurrence. Should leverage be limited? Should certain types of securities be banned? Should banks be broken up to reduce systemic risk? Should there be stronger consumer protections in lending? These are difficult questions with no easy answers. But agent-based models can help by allowing policymakers to simulate different regulatory regimes and see how they affect market dynamics. If you impose a leverage limit, how does that change the size and frequency of bubbles in the model? If you require more transparency about the underlying assets in securitized products, does that reduce the tendency for mispricing? If you introduce counter-cyclical capital requirements, where banks must hold more capital during booms and can reduce it during busts, does that dampen the boom-bust cycle? These models cannot give definitive answers. The real world is far more complex than any simulation. But they can build intuition and test ideas in a controlled environment before implementing them in the real economy. And they can reveal unintended consequences. A regulation that seems sensible might have effects that propagate through the system in unexpected ways. The model can help identify these possibilities. There is a deeper point here about the limits of prediction and control. One of the hard lessons of the financial crisis was that the experts, the people who are supposed to be monitoring the system and managing risk, did not see it coming. Or if they saw it, they did not act to prevent it. This failure has been attributed to many factors. Regulatory capture, where regulators become too close to the industries they regulate. Complexity, where the system becomes too intricate for anyone to fully understand. Ideology, where faith in the efficiency of markets blinds people to the possibility of systemic failure. And cognitive biases, the same ones that affect individual investors, that affect regulators and policymakers as well. The recognition that complex systems are fundamentally difficult to predict and control is humbling. It suggests that we should be modest in our ambitions. We cannot eliminate bubbles. We cannot engineer a perfectly stable financial system. What we can do is try to make the system more resilient, better able to absorb shocks without catastrophic failure. This is the philosophy behind some of the regulatory reforms that were implemented after the crisis. Higher capital requirements for banks, stress testing, restrictions on certain types of risky activities. The goal is not to prevent all problems, but to ensure that when problems occur, they do not cascade into systemic collapse. The artificial stock markets teach a similar lesson. In those models, you cannot eliminate volatility. The interactions between learning agents will always generate fluctuations, but you can sometimes reduce the amplitude of those fluctuations or make them less likely to snowball into crashes. For example, introducing circuit breakers, automatic trading halts when prices move too far too fast, can give the market time to digest information and can prevent panic selling from feeding on itself. Or introducing diversity in agent strategies can make the system more stable, because if different agents are using different forecasting methods, they are less likely to all buy or all sell at the same time. But here is the catch. Any intervention changes the incentives and the learning dynamics. If you introduce a circuit breaker, agents will learn to anticipate it and will adjust their strategies accordingly. They might rush to trade before the circuit breaker kicks in, which could make the initial price moves larger, or they might reduce their participation because they know they cannot exit positions quickly if they need to. The system adapts. This is a general principle in complex adaptive systems. You cannot simply engineer a fix and expect it to work as intended, because the components of the system, the agents, will respond to the fix in ways that may undermine it or create new problems. This is not an argument for doing nothing. It is an argument for humility and for careful monitoring. When you intervene in a complex system, you need to watch what happens and be ready to adjust. You need to think in terms of experiments and feedback, not in terms of permanent solutions, and you need to recognize that there will always be trade-offs. A regulation that reduces one kind of risk may increase another kind. A policy that makes the system more stable in normal times may make it more fragile under extreme stress. There are no free lunches. Let us turn now to another dimension of bubbles, their narrative structure. Bubbles are not just economic phenomena, they are also stories, collective narratives that societies tell themselves about the future. Every major bubble has had a story at its core. In the Tulip Mania, it was the story of the tulip as a rare and precious object of beauty, a symbol of wealth and status. In the South Sea Bubble of 1720, it was the story of vast riches to be made in trade with South America. In the Roaring Twenties, it was the story of modernity and progress, of a new era of prosperity brought by electrification, mass production, and the automobile. In the dot-com bubble, it was the story of the internet changing everything. In the housing bubble, it was the story of home ownership as the American dream and a can't-lose investment. these stories are not entirely false. There was something genuinely new and valuable in each case. Tulips were beautiful. Trade with the New World did create wealth. Electrification did transform the economy. The internet did change everything. Home ownership is important. The problem is that the stories became detached from reality, from the actual value that the new thing could generate. The story took on a life of its own, becoming a justification for ever higher prices. And because stories are social, they spread. People tell each other the story. Media amplifies it. Experts provide intellectual respectability to it. And soon it becomes the dominant narrative, the lens through which everyone interprets events. Robert Shiller, an economist who has studied bubbles extensively and who won a Nobel Prize for his work, emphasizes the role of these narratives. He argues that understanding bubbles requires understanding not just the economics, but also the psychology and the sociology, the stories people tell and why those stories resonate. A narrative takes hold when it connects to something deeper, to hopes and fears and values. The story of the internet was compelling not just because the technology was impressive, but because it tapped into a utopian vision of democratized information and communication. The story of home ownership resonated because it connected to deeply held beliefs about family, stability, and the good life. And these stories are not static. They evolve over time, adapting to new information and new circumstances. During a bubble, the story becomes more elaborate and more compelling. Disconfirming evidence is reinterpreted to fit the narrative. If there is a temporary dip in prices, it is just a buying opportunity, a chance to get in before the next leg up. If traditional valuation metrics suggest that prices are too high, those metrics are dismissed as outdated. New metrics are invented that justify the prices. During the dot-com bubble, investors stopped looking at earnings and started looking at page views and customer acquisition costs and other novel measures. The story adapted to maintain its plausibility, and then, when the bubble bursts, the story collapses. Suddenly, all the rationalizations that seemed so convincing look absurd. How could anyone have paid $50 for a stock with no earnings? How could anyone have thought that home prices could rise 10 or 20% a year forever? The story flips from one of limitless possibility to one of folly and excess. And this narrative collapse is part of what makes the crash so severe. It is not just that prices fall, it is that the entire framework for thinking about the asset disintegrates. People do not just adjust their valuations down, they lose faith completely. They want out at any price. The panic is as much about the narrative collapse as about the financial losses. The artificial stock markets do not explicitly model narratives, but they capture some of the underlying dynamics. The learning process in those models can be thought of as a kind of narrative formation. When trend-following strategies work, the implicit narrative is prices will keep rising. That narrative spreads as more agents adopt those strategies. When the trend breaks, the narrative collapses and agents shift to different strategies with different implicit narratives. The mathematics of learning and feedback produce patterns that mirror the rise and fall of narratives in real bubbles. There is also a political dimension to bubbles that is worth considering. Bubbles create winners and losers, and the winners often have a vested interest in keeping the bubble going. During the housing bubble, homeowners who saw their property values soar felt wealthy. Real estate agents, mortgage brokers, construction companies, everyone involved in the housing industry was making money. Politically, it was popular to promote home ownership. Both political parties in the United States supported policies that made it easier to buy homes. Questioning whether this was sustainable, whether prices had risen too far, was politically unpopular. Who wants to be the one saying that people should not be able to achieve the American dream, or that the housing market should cool down? The political economy of bubbles favours their continuation until the costs become undeniable. This creates a dilemma for regulators and policymakers. If you try to intervene early, to lean against the bubble while it is still inflating, you face enormous resistance. The people who are benefiting will push back. The political pressure to let the good times continue is intense, and there is always uncertainty. Maybe this time really is different. Maybe prices really are justified by fundamentals. Who are you to second-guess the collective wisdom of millions of market participants? This uncertainty gives cover to inaction. It is easier to wait and see, to hope that the market will correct itself gradually, than to take the political risk of trying to deflate a bubble that may not even be a bubble. And yet, if you wait until the bubble is obviously unsustainable, it is too late. The damage is already locked in. The crash becomes inevitable. So policymakers face an impossible choice. Act too early and you may be wrong and will certainly be unpopular. Act too late and you will be blamed for not preventing the disaster. This is why bubbles are so persistent. The political economy makes it very difficult to stop them before they burst on their own. The artificial markets offer an interesting perspective on this dilemma. In those simulations, you can introduce a policymaker agent, an entity that can observe the market and implement interventions. You can experiment with different intervention strategies. For example, the policymaker might raise interest rates when prices rise too far above fundamental value, making borrowing more expensive and cooling speculation. Or the policymaker might impose a tax on short-term trading, reducing the profitability of momentum strategies. Or the policymaker might require higher margin requirements during booms, limiting leverage. What these experiments tend to show is that interventions can sometimes reduce the size of bubbles, but they come with costs. Raising interest rates to cool speculation also slows the real economy, potentially causing a recession. Taxing trading reduces liquidity, which can make markets less efficient at incorporating information. Higher margin requirements protect against downside risk, but also limit the upside for legitimate investors. There are always trade-offs. And the effectiveness of any intervention depends on how the agents in the market respond, which is difficult to predict. There is also a timing problem. Even in the simplified world of artificial markets, it is not always clear when intervention is warranted. Prices can rise above fundamental value for good reasons, such as a genuine improvement in economic prospects. Distinguishing between a rational rise and a bubble in real time is extremely difficult, and if the policymaker intervenes too often or too aggressively, it can create moral hazard, the expectation that the authorities will always step in to prevent losses. This can encourage even more risk-taking, as investors assume they will be bailed out if things go wrong. This moral hazard problem was central to the debates after the 2008 financial crisis. Many large financial institutions were deemed too big to fail. If they collapsed, they would take the entire financial system down with them. So governments bailed them out, providing capital and guarantees to keep them solvent. This prevented a complete meltdown, but it also created a perception that the largest institutions would always be rescued. This perception encourages those institutions to take excessive risks. If they win, they keep the profits. If they lose, taxpayers bear the costs. This is sometimes called privatizing gains and socializing losses, and it is deeply unfair. But breaking the cycle is difficult. Allowing a systemically important institution to fail could trigger a catastrophe. So regulators are trapped, forced to bail out institutions they know are behaving recklessly because the alternative is even worse. The artificial markets can help us think through these problems by allowing us to simulate different policy regimes and see how they affect risk-taking and stability. For example, what if we require banks to hold much more capital, enough to absorb large losses without needing a bailout? This would make the system safer, but it would also make banking less profitable and could reduce the availability of credit. Is that a worthwhile trade-off? What if we break up the largest banks so that no single institution is too big to fail? This would reduce systemic risk, but it might also reduce efficiency, as smaller banks cannot take advantage of economies of scale. What if we impose stricter limits on the kinds of activities banks can engage in, separating commercial banking from investment banking, as the Glass-Steagall Act did in the United States from 1933 until its repeal in 1999? This might reduce risk, but it would also limit the ability of banks to serve their customers and could push risky activities into less regulated shadow banking. These are not questions with clear right or wrong answers. They involve judgments about values and priorities. How much do we value stability versus growth? How much do we want to constrain market freedom to prevent excesses? How much should individuals be responsible for their own investment decisions versus being protected by regulation? Different societies and different political systems will answer these questions differently. But what the artificial markets can do is illuminate the consequences of different choices, showing us in concrete terms how various policies might play out. Let us move now to the role of central banks in bubbles and crashes. Central banks, like the Federal Reserve in the United States or the European Central Bank, have enormous influence over financial markets through their control of interest rates and the money supply. When the economy is weak, central banks can lower interest rates to stimulate borrowing and spending. When the economy is overheating and inflation is rising, they can raise rates to cool things down. But this power comes with a complication. Low interest rates, while good for the real economy, also encourage speculation. When borrowing is cheap, investors are more willing to take risks, to buy assets with borrowed money, to chase returns in increasingly exotic investments. This dynamic played a role in both the dot-com bubble and the housing bubble. In both cases, the Federal Reserve had kept interest rates low for extended periods, first to deal with the aftermath of earlier crises, then to stimulate growth. These low rates made it very attractive to borrow and invest, which helped fuel the bubbles. When the bubbles burst, the Fed responded by cutting rates even further and by implementing unconventional policies like quantitative easing, buying vast quantities of government bonds and other securities to inject money into the financial system. These actions helped stabilize the economy and prevent deeper collapses, but they also raised concerns about creating the conditions for future bubbles. This is sometimes called the Greenspan put, after Alan Greenspan, who was chairman of the Federal Reserve from 1987 to 2006. The term refers to the perception that the Fed would always step in to support markets if they fell sharply, creating an implicit insurance policy for investors. This perception encourages risk-taking because investors believe they will be protected from the worst outcomes. But if everyone believes this and acts accordingly, taking on more risk than they otherwise would, the eventual crash can be even more severe when it comes. The insurance creates the very problem it is meant to prevent. Central banks are acutely aware of this dilemma. They face constant criticism from both sides. If they keep rates too low for too long, they are accused of fueling bubbles. If they raise rates to restrain speculation, they are accused of causing unnecessary economic pain. and they must make these decisions in real time, with imperfect information, and with the knowledge that their actions will be scrutinized and second-guessed. It is an unenviable position. The artificial stock markets offer a way to explore central bank policy in a controlled setting. Some models include a central bank agent that sets interest rates based on various rules. For example, the Taylor rule, named after economist John Taylor, suggests that central banks should raise rates when inflation is high and lower them when unemployment is high. You can implement this rule in an artificial market and see how it affects bubble dynamics. Or you can experiment with other rules, such as leaning against the wind, raising rates when asset prices rise rapidly, even if inflation is low. Or you can try a policy of benign neglect, where the central bank ignores asset prices and focuses only on inflation and employment. What these experiments tend to show is that no single policy rule is optimal in all circumstances. Sometimes leaning against asset price bubbles helps reduce their size and prevent crashes, but other times it causes more harm than good, depressing the real economy without effectively restraining speculation. The optimal policy depends on the specific characteristics of the bubble, on what is driving it, on how agents are learning and adapting. This suggests that central banks need to be flexible, adjusting their approach based on the situation rather than following rigid rules. But flexibility also means discretion, and discretion means that policy becomes less predictable, which can itself create uncertainty and volatility in markets. There is a philosophical dimension here that is worth pausing over. Markets are supposed to be mechanisms for discovering prices, for aggregating the dispersed knowledge of millions of participants into a single number that reflects the collective best estimate of value. This is F.A. Hayek's insight about the use of knowledge in society, one of the most profound ideas in economics. No single planner, no matter how smart or well-intentioned, can know all the information that is relevant to economic decisions. That information is scattered among countless individuals, each of whom knows their own circumstances, preferences, and opportunities. Markets bring all that information together through the price mechanism. When demand exceeds supply, the price rises, signaling scarcity and encouraging conservation and increased production. When supply exceeds demand, the price falls, signaling abundance and encouraging consumption. The price is a summary statistic, a compressed representation of everything everyone knows. But bubbles suggest that this process can go badly wrong. Prices can rise not because of genuine scarcity or increased value, but because of self-reinforcing feedback loops. The market is not discovering the right price. It is generating a wrong price, and that wrong price persists for months or years before eventually correcting in a crash. How can this be reconciled with the idea of market efficiency? How can we trust markets to allocate resources if they sometimes produce such large and persistent errors? One response is to distinguish between different types of efficiency. The weak form of market efficiency says that past prices cannot be used to predict future prices, that technical analysis does not work. The semi-strong form says that all publicly available information is already reflected in prices, that you cannot beat the market by reading the news. The strong form says that even private information is reflected in prices, that even insider trading would not generate excess returns. Most economists believe in the weak and semi-strong forms, but not the strong form. But bubbles challenge even the semi-strong form. If prices can rise far above fundamental value and stay there for extended periods, then clearly not all public information is being correctly incorporated. The information about future dividends, about sustainable earnings, about the limits to growth, That information is public. Anyone can calculate that the prices do not make sense, and yet the prices persist. This suggests that something is interfering with the market's ability to aggregate information correctly. The artificial markets point to what that something is. It is the learning process, the feedback between prices and beliefs. When agents form their expectations based on recent experience, and when their actions based on those expectations influence the very prices they are trying to predict, you get dynamics that can push the market away from equilibrium. The market is still aggregating information, but it is aggregating information about what other people believe and what strategies are working, not just information about fundamentals. And when beliefs become detached from reality, when successful strategies are those that chase trends rather than those that estimate value, the market can produce prices that are very wrong by any reasonable measure. This does not mean markets are useless. Even with all their flaws, markets are still better than the alternatives at allocating capital and coordinating economic activity. Centrally planned economies consistently performed worse than market economies in the 20th century, and the main reason was their inability to process information effectively. Markets work reasonably well most of the time. It is only occasionally during bubbles and crashes that they fail dramatically. The challenge is to understand why these failures occur and whether anything can be done to make them less frequent or less severe without undermining the benefits that markets provide. The artificial stock markets are part of that effort to understand. They are tools for exploring the boundary between market efficiency and market failure, for understanding the conditions under which learning and feedback lead to convergence toward rational prices versus divergence into bubbles. And what they reveal is that this boundary is not sharp. There is no clear line separating efficient markets from inefficient ones. Instead, there is a spectrum with stability and instability coexisting, with the same mechanisms sometimes producing good outcomes and sometimes producing bad ones depending on parameters and circumstances. This is a humbling insight. It means we cannot simply fix markets once and for all. We cannot design the perfect regulatory system that will prevent all future crises. What we can do is try to make markets more robust, more resilient to shocks, better able to recover from inevitable mistakes. We can try to reduce leverage during booms so that busts are less catastrophic. We can try to improve transparency so that risks are better understood. We can try to maintain diversity in strategies and perspectives so that not everyone is doing the same thing at the same time. We can try to build financial institutions that can withstand losses without collapsing. These incremental improvements, layered on top of each other, can make a difference. Not a perfect market, but a more resilient one. Let us turn our attention now to a more recent phenomenon, one that combines many of the themes we have been exploring. Cryptocurrency, particularly Bitcoin, and the thousands of other digital currencies that have been created since, represents one of the most fascinating bubbles of the 21st century. The cryptocurrency market exhibits extreme volatility, with prices sometimes doubling or halving in a matter of weeks. It attracts passionate believers who see it as the future of money, and equally passionate skeptics who see it as a speculative mania with no intrinsic value. And it raises all the questions about bubbles, learning, narratives, and market dynamics that we've been discussing. Bitcoin was created in 2008, during the depths of the financial crisis, by a person or group using the pseudonym Satoshi Nakamoto. The timing was significant. Trust in traditional financial institutions was at a low point. The banks had failed, the regulators had failed, the entire system seemed broken. Into this environment came a proposal for a new kind of money, one that did not depend on banks or governments, one that was decentralized and cryptographically secure. The technology behind Bitcoin, the blockchain, was genuinely innovative, a clever solution to the problem of how to maintain a shared ledger without a central authority. In its early years, Bitcoin was used primarily by cryptography enthusiasts and libertarians, drawn to its anti-establishment ethos. The price was low and volatile, but mostly ignored by mainstream investors. Then, gradually, it began to attract wider attention. The price started to rise slowly at first, then more rapidly. By 2013, Bitcoin had reached over $1,000, up from just a few cents a few years earlier. Then it crashed, falling to around $200. Then it recovered and rose again. By late 2017, it had reached nearly $20,000. Fortunes were being made. People who had bought Bitcoin years earlier for a few dollars were now millionaires. The media was full of stories about cryptocurrency. Everyone seemed to be talking about it. And then, once again, it crashed, falling to around $3,000 by the end of 2018. The bubble had burst. Or had it? Unlike previous bubbles, where the asset largely disappeared from public consciousness after the crash, Bitcoin and other cryptocurrencies did not go away. They stabilized, traded in a range for a while, and then began rising again. By late 2020 and into 2021, Bitcoin reached new all-time highs, exceeding $60,000. Another bubble? Another mania? Or something more substantial? The cryptocurrency market is a fascinating laboratory for studying bubbles because it is so transparent. Every transaction is recorded on the blockchain. Trading happens 24 hours a day, 7 days a week, across exchanges all over the world. The price data is public and granular, and the market is relatively new, so we can observe its evolution from the beginning. Researchers have applied many of the tools developed for studying traditional markets, including agent-based models, to cryptocurrency. What they find is that the dynamics are similar to other speculative markets, but amplified. The volatility is extreme. The boom-bust cycles are rapid and dramatic. The herding behavior is pronounced. One reason for this is the composition of the market. Cryptocurrency investors are disproportionately retail investors, individuals rather than institutions. These retail investors tend to be more emotional, more influenced by social media and news, more prone to following trends. The market also includes a lot of novice investors, people with little experience who are attracted by stories of quick riches. This mix creates conditions ripe for bubbles. When prices start rising, inexperienced investors pile in, chasing the trend. Social media amplifies the excitement. FOMO, fear of missing out, drives more buying. The bubble inflates rapidly. Then, when prices start falling, panic sets in. The same social media channels that were full of bullish hype turn bearish. Everyone tries to sell at once. The crash is as dramatic as the rise. But there is something else going on with cryptocurrency beyond simple speculation. There is a genuine ideological component. Many cryptocurrency enthusiasts are true believers in the technology and in the vision of decentralized finance. They see traditional banking as corrupt and inefficient. They believe that cryptocurrencies represent a fundamental improvement, a way to give individuals control over their own money without intermediaries. This ideological conviction makes them more willing to hold through the volatility, to buy during crashes because they believe in the long-term future of the technology. This creates a floor under the price, a base of support that has allowed cryptocurrencies to survive multiple crashes that would have killed other speculative assets. The narrative around cryptocurrency has evolved over time. Initially, it was about being a currency, a new form of money for online transactions. But Bitcoin turned out to be poorly suited for everyday transactions. It is slow, expensive to use, and its price volatility makes it impractical as a medium of exchange. So the narrative shifted. Bitcoin became digital gold, a store of value, an inflation hedge. The argument was that because there is a fixed supply of Bitcoin, only 21 million coins will ever be created, it cannot be debased by central banks printing money. This narrative resonated during periods of central bank activism when worries about inflation were rising. More recently, other narratives have emerged. Ethereum, the second largest cryptocurrency, is positioned not just as money, but as a platform for decentralized applications, smart contracts that execute automatically without intermediaries. Non-fungible tokens, NFTs, which are unique digital assets recorded on a blockchain, became a massive bubble in 2020 and 2021, with digital artwork and collectibles selling for millions of dollars before the market collapsed. Decentralized finance (DeFi) promised to recreate traditional financial services, lending, borrowing, trading, without banks or brokers. Each of these narratives attracted waves of investment and speculation, creating mini-bubbles within the larger cryptocurrency bubble. From the perspective of the artificial stock markets, what is interesting about cryptocurrency is how clearly you can see the role of narratives and learning. The market goes through cycles where trend-following strategies dominate, pushing prices up rapidly, followed by crashes where those strategies fail. The learning process is visible in real time. When prices are rising, analysis of social media and trading patterns shows that momentum strategies proliferate. Everyone is trying to ride the wave. When prices crash, the sentiment shifts dramatically. Suddenly, everyone is talking about the risks, about the volatility, about how they should have sold at the peak. And yet, despite multiple crashes, each one resulting in price declines of 70 to 80% from peak to trough, the market keeps coming back. New investors enter. New narratives emerge. This cycle repeats. Why? Partly because the underlying technology continues to develop. Cryptocurrencies and blockchain are being adopted for various use cases, from international money transfers to supply chain management. Whether they will ultimately live up to their revolutionary promise is still an open question, but the technology is real and continues to attract serious investment. Partly because the global monetary environment, with near zero or negative interest rates in many developed countries and concerns about inflation and currency debasement, creates demand for alternative stores of value, and partly because of network effects. As more people own cryptocurrencies and more merchants accept them and more infrastructure is built around them, they become more valuable, which attracts more users, creating a positive feedback loop. The cryptocurrency bubble, or series of bubbles, illustrates several key themes from our exploration. It shows how new technologies create uncertainty and opportunity, which attracts speculation. It shows how narratives evolve to rationalize rising prices. It shows how learning and feedback can create cycles of boom and bust. It shows how retail investors, enabled by technology to trade easily and influenced by social media, can amplify volatility. And it shows the difficulty of distinguishing between genuine innovation and speculative excess in real time. As we drift deeper into the night, let us gather the threads of our journey and weave them into something like understanding. We have travelled from tulips in 17th century Amsterdam to artificial stock markets in 1990s New Mexico to cryptocurrency in the 21st century. We have explored the psychology of greed and fear, the mathematics of feedback loops, the politics of regulation, the philosophy of markets and knowledge, and throughout, we've been guided by a central insight from the artificial stock markets. Bubbles are not anomalies. They are natural consequences of how learning agents interact in complex systems. They emerge from the interplay of rational individual behavior and system-level feedback. They are, in a sense, inevitable features of market economies, part of the cost of having systems that are flexible and adaptive. This does not mean we should simply accept bubbles as unavoidable and do nothing about them. But it does mean we should be realistic about what is possible. We cannot eliminate bubbles. We cannot engineer perfect stability. What we can do is work to make the financial system more resilient, to reduce the damage that bubbles cause when they burst. We can limit leverage so that losses are not amplified beyond what the system can bear. We can improve transparency so that risks are better understood and priced. We can maintain diversity in market participants and strategies so that not everyone is doing the same thing at the same time. We can strengthen financial institutions so they can withstand shocks. We can design better circuit breakers and other automatic stabilizers. We can improve financial literacy so that individuals are better equipped to evaluate risks. None of these measures is a panacea. All of them involve trade-offs, but taken together, they can make a difference. The goal is not to prevent all problems, but to ensure that when problems occur, they do not cascade into catastrophes. This is the lesson of resilience, a concept borrowed from ecology and engineering. Resilient systems are not ones that never experience shocks. They are ones that can absorb shocks and recover. A forest is resilient if it can survive a fire and regrow. A building is resilient if it can flex in an earthquake without collapsing. A financial system is resilient if it can survive a bubble bursting without triggering a depression. The artificial stock markets are tools for building that resilience. They allow us to experiment with different designs, to test ideas before implementing them in the real world, to build intuition about complex dynamics. They are not perfect models of reality. They simplify many things and omit others, but they capture enough of the essential dynamics to be useful. And as these models become more sophisticated, incorporating more realistic representations of market structure, more diverse types of agents, more connections to the real economy, they will become even more valuable. There is also a broader lesson here about the relationship between humans and technology. Financial markets are increasingly mediated by computers. Algorithmic trading, artificial intelligence, machine learning. These technologies are reshaping how markets operate. In some ways, this makes markets more efficient. Computers can process information faster than humans, can detect patterns that humans miss, can execute trades with precision and speed that humans cannot match. But it also introduces new risks. Algorithms can interact in unexpected ways, creating flash crashes and other forms of instability. Machine learning systems can amplify biases in the data they are trained on, leading to systematic errors. And the speed of modern markets means that problems can escalate to crises before humans even realize what is happening. The artificial stock markets, ironically, were created to understand human behavior in markets. But they have also become blueprints for how actual markets operate now that so much trading is done by algorithms. The agents in the Santa Fe artificial stock market were simple learning algorithms. Today's trading algorithms are vastly more sophisticated, but they are still fundamentally agents learning from data and adapting their strategies based on what works. The dynamics we observe in the artificial markets, the feedback loops, the emergent volatility, the boom-bust cycles, These are increasingly the dynamics of real markets. Understanding the artificial markets is not just an academic exercise, it is essential for understanding the markets we actually have. As we approach the end of our journey together tonight, I want to return to where we began, to the fundamental question of why markets sometimes go mad. We have seen that the answer is not simple. It is not just about irrationality or manipulation or regulatory failure, though all of those can play a role. It is about the inherent dynamics of systems where agents must learn and adapt in environments that are themselves shaped by their learning and adaptation. It is about feedback, both positive loops that amplify small disturbances into large swings, and negative loops that eventually pull the system back towards stability. It is about the stories we tell ourselves and each other, the narratives that make sense of an uncertain world and that can become self-fulfilling prophecies. It is about the political economy, the interests and incentives that favour letting bubbles inflate even when the risks are visible. Understanding bubbles requires understanding all of these layers: the individual psychology, the system dynamics, the social narratives, the political constraints. No single theory or model can capture all of this complexity, but by combining insights from behavioral economics, complexity science, agent-based modeling, historical analysis, and practical financial experience, we can build a richer picture. We can see bubbles not as mysterious aberrations but as natural, if unwelcome, features of market systems. And we can use that understanding to design better policies, better institutions, better ways of managing risk. The artificial stock markets have been a crucial part of building that understanding. They have shown us that bubbles can emerge from simple rules and basic learning mechanisms. They have revealed the importance of feedback loops and agent heterogeneity. They have provided laboratories for testing interventions and regulations. They have connected the mathematical abstractions of economic theory to the messy reality of actual markets, and they continue to evolve, becoming more sophisticated and more widely used as tools for research, education, policy analysis, and risk management. As you drift towards sleep, I hope you carry with you a sense of the intricate beauty and the troubling fragility of the economic systems we have created. Markets are human constructs, tools we have developed to coordinate our activities and allocate our resources. They are not natural laws, they are not perfect, but they are, for all their flaws, remarkable achievements. They allow millions of strangers to cooperate without anyone being in charge. They channel innovation and entrepreneurship. They create wealth and opportunity. And yes, sometimes they produce bubbles and crashes, moments when the system seems to have lost its way, when prices detach from reality and fortunes are made and lost based on nothing more substantial than collective belief. These moments are painful, but they are also instructive. They reveal the limits of our knowledge and the complexity of the systems we have built. They humble us and remind us that we're not as rational, not as in control as we would like to think. And they challenge us to do better, to learn from our mistakes, to build more resilient systems that can withstand the inevitable shocks. The economics of bubbles and crashes, what artificial stock markets have taught us about real ones, is ultimately a story about learning, about how we learn in markets, how our learning creates dynamics that can stabilize or destabilize, and how we can learn from studying those dynamics to build better markets. It is an ongoing story, one that will continue to unfold as markets evolve and as our tools for understanding them improve. Rest now, with the knowledge that the patterns we've explored tonight will continue to play out in markets around the world. that the dance of prices will go on, sometimes graceful and sometimes chaotic, but always reflecting the collective hopes and fears and calculations of millions of human minds, and increasingly, millions of algorithmic minds, all trying to navigate an uncertain future. The bubbles will form again, the crashes will come. But with deeper understanding, we can hope to navigate them with greater wisdom, to build systems that are more forgiving of our limitations and more supportive of our aspirations. Sleep well, knowing that somewhere markets are open, prices are moving, traders both human and algorithmic are making their bets on an unknowable future. And somewhere, researchers are building better models, testing new theories, trying to decode the mysteries of how markets work and why they sometimes fail. The work continues, the learning continues, and slowly, incrementally, our understanding grows. Until we meet again in another night of gentle exploration, may you find peace in uncertainty, wisdom in complexity, and hope in the knowledge that even our failures teach us something valuable about who we are and how we navigate this intricate world together.